2, 1.
All right,
Here we go.
let's get it on.
What are we getting
Another
on?
crazy week.
I think we say that every week now.
I know, man.
I think it's crazy.
Yeah. I mean, it's been such a long week. There's so much stuff going on. I'm going to try to get through this in some kind of way that makes sense. But if it's a little bit jumbled up, kind of bear with me. You can poke at me if I get too far off track. Yeah. Anyway, let's just do it. TSP Weekly Podcast, 19 November 2023. So we'll talk about a little bit some of the events that happened this week, and then we're going to look at betting on bonds. We've been talking about it for a long time, the F fund, but it looks like potentially the bottom is in for bonds. And it's also the beginning of forecast season, which is being kind of overshadowed by Fed forecasts as opposed to stock market forecasts. So we'll look at a couple articles about that. And then how Elliott Waves can help. So there's been a couple of comments on Facebook in the group about, like, Elliott Waves don't seem to work. Like, how do we use them? What's really the value there? And we're going to kind of talk about that throughout. And then get a kind of a different C-Fund chart at the end. So Tuesday morning, 8:30, CPI comes out. And then Wednesday, PPI comes out. But CPI was really the name of the game for the week. And then way overshadowed this whole idea of we're not having a government shutdown, which, in normal times would have pushed the market up anyway. But CPI was really the thing. The funniest for me, I was laughing about it today out loud, actually. These two terms they're talking about on Bloomberg: immaculate disinflation and Santa Claus meets Goldilocks. Okay, so what happened at CPI? The CPI is it's the inflation number. It's the biggest inflation number that the Fed tracks, right? So consumer price index and producer price index, basically they tell us how much inflation is going on in the system. And both of those numbers came in much lower than what analysts expected, right? So if inflation's going down and rates are high, which we're going to get charts on that too, but if inflation's coming down and rates are high, the Fed is raising rates to try to bring inflation down. That's the point. It's been the point since the beginning of this rate tightening cycle. Now that inflation is coming down, that means the Fed can start easing interest rates, right? Because it's accomplishing its mission. Unemployment is 3.9% right now. So unemployment is low. So the Fed has two mandates, right? Stable prices, and low unemployment. So stable prices will happen when inflation comes down. Okay, so the prices are stabilizing, which is what we want, and unemployment is not going up, which is what we want. So the market looks at it and says, well, then the Fed should start lowering rates, right? That is the Goldilocks scenario. That's what that is. And the idea is that if unemployment doesn't tick up and inflation keeps coming down, then the Fed lowers rates, the economy is good, and they start easing money again, and so stocks go up and everything goes up, and we keep on going like nothing ever happened. If you have the time to watch Bloomberg, you would see all these people on there that have a very different opinion of this. The Goldilocks thing, that the idea is that they talk about hard landing or soft landing, right? Every hard landing starts with a soft landing, right? It's the transition. I was listening to a guy about it last night. Every hard landing begins with this transition, which is a soft landing in the beginning, and then it turns into a hard landing. And so, a lot of people, basically everybody, we did a show on it last year. Virtually everybody was expecting a recession in early 2023 and then a recovery in the second half of the year. That is what every analyst expected at the beginning of last year, and we didn't get any of it. So I'm going to kind of ping back to that as we go through this, because that goes to this idea that when everybody is on the same side of the trade, it tends to go the other way, right? That's kind of an ism. Like, everybody knows that when everybody's on one side of the boat, it's gonna go the other way, right? Sometimes that's true. Sometimes it's not true, right? All right. So anyway, Santa Claus meets Goldilocks. Obviously, we're getting into the Santa Claus rally time of the year. S fund, small caps almost always outperform December into January. So doesn't mean it's going to happen this year, but when rates come down, the S fund, small caps are more, they're going to get the better end of the deal basically than large cap companies. So all these companies that like the zombie companies that we talk about, if rates come down, they're able to rework the loans at a lower rate, and now they can keep going. And so the fact that they're going to be able to do that as rates keep coming down makes their stock more valuable, right? That's what's kicking it up. And large cap, it doesn't affect them as much as small caps. So it's going to be interesting to see how this whole thing plays out over the next few months. So what did it look like on a chart this week? What happened? So here was interest rates at 5%, right? They were banging up against 5% for 1, 2, 3, this about a week or two at 5%. And then we had this was the bottom in stocks, right, the end of October. And then we had this big candle down, which really kicked off the rally that started the 1st of November. And then we had this gap down. And that was the first big rally day from week before last. Week before last. And then so that was a big move down in yield. Okay? So when yield goes down, the price of bonds goes up, so the F fund goes up. And it was also this idea that yield comes down, which means the rate is coming down, and so it's good for stocks, right? So stocks and bonds go up. So we have this big rally. Yield consolidates and then puts in that reversal day right there to the 20-day moving average line. And then the next day, yield collapses, okay? It takes out this, I think this was Tuesday. That was Tuesday. Yield collapses, takes out all of this, right? And so now what it looks like is we are in this new down channel in yield, which is great for stocks, as we saw over the past couple of weeks, and great for the F fund. So that's like a picture of what all this interest rate stuff means, basically. Okay, so this article was out 3:30 in the morning on Tuesday. Okay, so it was before that big rally on Tuesday, or before the CPI report came out. So investors dump cash to chase bonds. This is an example of when these kind of headlines come out, everybody is on the same side of the trade, right? And this is a report, like this is just a reporting of what's actually happening, not somebody, talking about what they think is going to happen.
He's not forecasting.
Right, this isn't a forecast.
Yeah, he's just reporting what happened.
He's reporting the data, right. So, okay. Inflation expected to slow to 3.3, and we actually got a better than 3.3 number. And so the investors that dumped cash to chase bonds got a really good day on Tuesday. So here's what they say. Investors turned the most bullish on bonds since the global financial crisis on big conviction that rates will move lower in 24, okay, according to this Bank of America survey. Monthly survey shows investors were dumping cash to hold the biggest overweight position in bonds since 2009, okay? So they flipped, and they're just reporting what happened. They flipped from cash to overweight bonds the most since 2009. So depending on how you look at this, you're going, okay, if all those people are going to that side of the boat, that can't be the trade that you want, right? You must want the other trade. Okay, so global stocks and bonds advanced in November after slumping, blah, blah, blah. Bank of America survey showed the conviction of peak Fed rates is now the strongest since the poll began asking investors the time that the rate cycle would end, right? This prompted cautious investors to cut cash levels from 4.7 to 5.5 down to a 2-year low. So everybody's piling into bonds. Participants also flipped their positioning on equities to overweight. So they're going for the first time since 2002, April 2002. So now they're overweight stocks. They're most net overweight pharmaceuticals, tech, which is the biggest one, and telecommunication stocks, right? So the most net underweight, utilities, materials, and discretionary. Investor playbook for 24 is a soft landing and lower rates. And a weaker dollar. Survey saw investors increase allocations to U.S. stocks and Japanese stocks, decrease exposure to Europe and UK. So 2 out of 3 investors see soft landing as the base case, right? The Goldilocks, like we were talking about. Soft landing, we don't have a recession. So 2/3 of people they surveyed, that's what they think is going to happen. The most crowded trades are long big tech, which makes sense because the Magnificent Seven is pushing us up, right? Long big tech, short China, okay, and long treasury bills. So the ironic thing on this, to me, is that if you look at a chart of the S&P 500 or the NASDAQ is more, but stocks are going up. They've been going up since October of last year. Bonds have been going down. And we're going to look at some of the bond charts, but we are at the bottom of a 3-year 5 move down in bonds. So when yield goes down, the price of the bonds go up. When yield goes down, it's a tailwind for stocks, so it's good for stocks. But the count of you can say the Elliott Wave count, or you can say the valuation of stocks to bonds. Bonds are way undervalued versus stocks. Stocks are very expensive right now. Bonds are historically cheap. How can you be overweight both? How can you be overweight tech and overweight bonds? Someone's going to be right? And it's timing, but it's fascinating, the stuff that's going on right now. This is a different article, also from Yahoo Finance, but a different article. Each fall, Fed or Wall Street strategists publish their forecast. So this is where I at first started looking at this, the forecast, right? So, and while the anticipation for this year's crop is as high as any other year, there's another type of outlook drawing even more attention to investors in 2023. It's the forecast of the Federal Reserve, specifically predictions on when the Fed will begin cutting interest rates in 2024. So UBS says we should get a 2.75% cut beginning in March. So by the end of the year, rates get cut 2.75%. We're at 5%, basically 5% now, let's say. It's down a little bit, but let's say we're at 5%. That means you're cutting rates more than half of where we are right now. That pushes the F fund way up, and long-term treasuries up even more. It's also the time to probably buy a house if you're trying, or anything else if you need to mortgage it. Goldman Sachs, on the other hand, says no lowering until fourth quarter 2024. Okay, they think rates don't come down until 24. Morgan Stanley, 1% cut in 24, but beginning in June. And then Barclays is saying we're going to get another rate hike in January and no cuts until 2024. So you get the smartest guys in the world ranging from a 2 3/4% cut, we're going to cut more than half of what we've raised beginning in March, all the way to, nope, we're going to get another rate hike in January. The smartest guys in the world have, let's just say, drastically varying opinions about what's going to happen going forward. And then you get the Fed, which nobody believes anyway, but they say we're going to keep rates higher for longer. So 2 key reasons to call out the importance of Fed forecast for next year. First, there's essentially no disagreement, right? That was the thing that got me to put this in the slide deck. There's essentially no disagreement. There was no disagreement last year. I mean, we were going to have a recession the first half of the year, and then we're going to get a recovery in the second half of the year. There was no disagreement. Now there's also no disagreement that the Fed will cut rates in 24. Right, just as there was almost no disagreement at the end of 22 on what 23 would have in store for investors, a shallow recession followed by a rebound in the stock market, right? Just like what we said. Second, lower interest rates result in higher stock prices, all else being equal. Okay, that's true. All else being equal, decreasing rates is good for stocks. Rate cuts that come in response to a recession, however, pose a challenge in serving as a positive catalyst for stocks. Earnings for the S&P fall by an average of 31% over 6 quarters during recession, with a recovery back to pre-recession levels taking 3 years. This is the big question mark. The Fed starts cutting rates. Why does the Fed cut rates? If you think that the Fed, it's first of all, the Fed's saying they're not going to cut rates. Second of all, if the economy is doing well, you would think they would have learned their lesson from the last decreasing rate cycle, right? Rates after 2008, rates come down to basically almost zero. They're at 0.5%. They stayed there for like 12 years. And that's what created the bubbles that we've had. Why, if the economy is doing well, unemployment's low, inflation's coming down, why does the Fed lower rates when the Fed is telling you it's not going to lower rates? Like, there's no upside for the Fed to lower rates when everything is doing well.
Just to go right back where we were.
Yeah, because they know that that's what causes the problems in the first place.
Yeah,
right?
Because we stayed down there too long in the beginning.
Yeah.
That's the whole point.
Right.
That's why I'm a little bit more on that side of, like, they're not going to be in a hurry to lower rates until it's just too much. Right.
Right.
Now, if something breaks, they've already said they're going to.
Right.
But I think what they're hoping is they can keep it the way it is longer and longer and longer. And if something breaks, great, then they'll lower it. They'll start to lower it. Right.
Well, even like at some point there'll be some kind of wobble, and
Right.
they'll lower rates. But because that happens all the time.
But the idea that they'll just do it.
Yeah. No.
Because it's March of 24.
Yeah.
I'm not buying that.
The biggest things, again, that jumped out to me is that there is essentially no disagreement.
Well, it's sort of like what Ken Griffin said in his interview the other day. The guy that what is his Citadel.
Yeah.
So the guy from Citadel, he was laughing with the journalist. He says all of us economists are right at some point.
Yeah. Yep, we're all gonna be right.
He's like, it'll be true at some point.
Yep.
And so that's what they get to fall back on, right? Is like, I wasn't wrong. It just it didn't happen yet.
Right.
And that's
there's gonna be a recession.
Yeah. I mean, we've fallen into that sometimes. I mean, you're looking at the charts and you say, hey, this is where it's headed, and it is headed that way at some point.
Yeah.
We can't tell when.
Yeah.
And some of this, that you're kind of describing in there, these guys, Barclay and Morgan Stanley, they're all, in agreement in a sense that it's going to happen. They're all just have differing opinions of when. Right. And some of them will be right, and some of them will be wrong.
The interesting thing here is really the why. Like, does the Fed lower rates
because of XYZ?
Yeah, I mean, does it lower rates because, okay, everything's fine and we can ease back the throttle a little bit? Or does it lower rates because something broke and rates are collapsing in a hurry? In scenario one, which is the Goldilocks scenario, stocks keep going higher. They just keep going higher. Scenario two, the Fed is trying to put a floor on stocks that are falling. So it's... And nobody knows. Nobody has a crystal ball. Obviously, these guys are all over the map. So interesting stuff. All right, and then so they said there's no disagreement, right? Except for Jamie Dimon, who arguably is the smartest guy in the room, and he's saying, now this is back beginning of October. Okay, so perhaps he's changed his opinion a little bit. I don't know. I haven't seen an update, but He's been doubling down on this idea that, rates right, Fed funds rate right now, 5.25 to 5.5. This was before November, so we did not get. Okay, so most analysts say that central bank will raise rates just one more time. That obviously didn't happen in November, but they thought they were going to get another 0.25% rate hike. However, Dimon tells Bloomberg it's possible the central bank will continue hiking rates by another 1.5% to 7% on the Fed funds rate. 7%. And then he doubles down and with another interview at the Times of India and says the world's not prepared for 7% Fed funds rate. I mean, so clearly he is not on board with what did they say before? Everybody's in agreement. Jamie Dimon is not in agreement, right? Now, the market is proving him wrong right now. Doesn't mean that this isn't just a pullback and rates go higher from here. In the long term, I think he's going to end up being right. I think we do see 7%, but not before it comes back down meaningfully. There are a lot of potential bad outcomes. The worst case is stagflation with low growth and high interest rates. This is the camp I'm in. This is where I think we're going to end up. Okay, so why is everybody on the side that overweight bonds? Okay, this is the TLT, 20+ year Treasury bond. So we've been talking about this chart for a long time. If you're a fundamental kind of person, and if you watch Wealthy On or basically anybody, I mean, that they're talking about how bonds have been getting clobbered for the last 3 years. And at various points along there, they'd be like, hey, bonds are down 30%. Like, it's a great time to get in bonds because they're down 30%. And bonds get down 40%. It's an even better time to get in bonds, right? So if you're looking at the fundamentals of the stuff and you're betting basically, you're like, we have to be at a bottom, I'm going to buy it here. You buy it there and it keeps going down. At some point, it's going to hit a bottom. So if you're a technical guy and you're looking at it, you're saying, okay, and we've been talking about it on the show for close to a year probably, because this Elliott Wave pattern was so crystal clear. We get a top in 2020. We get that first big move down. We get a recovery rally for a 2 wave, right? This is the 1, this is the 2. And then once we got below this low, this is where everybody's like, oh, it's the best time to buy bonds, right? Historical drop in bonds, this is the best time. It's double bottom, best time to buy bonds. And it keeps going down. Once it started going down, then now the next best thing you can hope for is that this length is the same as this length, right? That would be an ABC correction. Once it gets past that, now your count is a 5 wave. So the Elliott Wave works on probabilities. And once one count becomes, can't remember the word.
Improbable?
Well, yeah, I mean, it gets taken off because it's canceled out. Yeah. So then you just redo the count, right? And you can say, okay, I'm looking at, I had this big move down. I got a pretty decent recovery, say it's the 38%, I'm not sure, but let's just say this is a 38% retracement back up for that recovery rally. And then if I can get this length being the same, that's my next target. If it blows through that target, now your count has changed from an ABC to a 1, 2, 3, 4, 5. And that's what happened. We got a 1, 2, 3, 4, and we've been talking about for months that this 5 wave, once it completes, is a historic opportunity in bonds, because the 5 wave down means you're going to get a 2 wave back up or 3 wave back up, right? You're going to get an ABC recovery and then comes back down. That's what the chart calls for. So if we get that.
Is there another possibility though? How far can the 5 go down?
Well, okay, let's do that first. So the 5 always has a question mark, right? And when they said in that article that everybody is overweight bonds, this is how you see that. Price kept going down. We had a low here. Price kept going lower. But RSI moved higher. So we talk about this divergence all the time. We had a divergence between relative strength and price. And then it got confirmed when we broke above that 20-day moving average line right there. Yeah.
That's a little tough to see.
It's hard to see, yeah. But you can see that price now, over the past couple of weeks, is consolidating above that 20-day moving average line.
That's the real indicator, right?
Yeah.
That the 5 wave could be turning because relative strength changed.
Right.
Price changed. They confirmed it, right?
Yeah.
And now you're looking at, okay, well, if we start this ABC correction, then
Yeah. I mean, there's no guarantees for any of this, but
you do have to let it play out a little bit, or otherwise you can't confirm it.
Right. It depends on how much you want to confirm it.
Because it could roll right back over.
It could. This is a low risk buying opportunity.
Right.
You get 3 years and a 50%, almost 50%. So we were up here at $160. and we are down here now, almost 80 was the low. So that's a 50% decline. So if you were sitting in TLT, you lost half of your money over the last 3 years. In a 5-wave cycle down with divergence between price and RSI at this point, it's a giant like green flag. Because it's so oversold, now is a good time to get in, because if it breaks below here, you just get out. Yes, you have this risk. That's your level of risk at this point. But the potential upside is like that. So there's no guarantees, but this is a great setup. Let's just say that. All right. So how did we, if you were a subscriber to the site, what did you know about going into this week? Okay. So this was the bottom line from the newsletter that we put out last Sunday. So in the short term, virtually everything is bullish for stock funds. A pullback in the C fund, like we saw in the S&I funds, would have been preferable, but not necessary. We have both the dollar and yield in a bearish setup that's bullish for stock funds, and the seasonal pattern is certainly in our favor. So everything was bullish back last weekend, right? In the short term. In the long term, there's nothing bullish for stocks. Okay. Elliott Wave count for the C fund and the price pattern of the S fund both call for the next move coming to the downside. The question you need to ask yourself is this: am I willing to be in the stock funds for some anticipated short-term gains, understanding that the next primary move is likely to the downside? It's all a game of probabilities. No guarantee that the Elliott Wave count is correct. An aggressive investor might get back into the stock funds here, watching the market closely for an exit point. A conservative investor may be happy to avoid the risk and take the gains in the G fund. It comes down to your personal circumstances and risk tolerance. The most important lines are 4,600 on the S&P 500. Above that, the Elliott Wave count is wrong. Below 4,100 means the bear market's confirmed, and we keep going lower. So what was I talking about exactly? This is the primary Elliott Wave count for the S&P 500. We had 5 move down that finished in October of last year. And we have this A, ABC for a B, and a C. And now we're in this down channel. Okay? We had a 1, 2, 3, 4, 5 down to the low in October. And we have this move higher. So the question is, how high does the 2 go? Okay? So that's the big picture Elliott Wave count. And the count is still in place. It's still valid. Yes, right now we're up here at a little bit above 4,500. That does not invalidate this count. If we get above 4,600, because wave 1, right, wave 2 cannot retrace the whole length of wave 1. That's why 4,600 matters. Okay? But until you get up there, the count is still this. This is the C fund that I was talking about. Huge rally off the bottom of the C fund. We got a 1-day pullback to the 50-day moving average line. That doesn't really count as a pullback. It's certainly not a tradable pullback. We're talking about, ideally we would have had something like a pullback to here that would give us a higher low. And once we saw that that was in there, that would be a good time to get in, because now the trend has changed. We didn't get that on the C fund. On the S fund, we did get that. Okay, and this is the chart that we put out on the S fund last weekend. We had the rally. We had the pullback right to the 20-day moving average line, right to 50 RSI. And so is this pullback enough? We didn't get a good pullback in the C fund, but in the S fund we did. So is that enough? I fund, same thing. Rally, pulled back, came right down to that 20-day moving average line. So in the S and the I, we have pullbacks that are setting us up for a higher low. Okay? There's no guarantees. It could have kept going down, because you don't know until it proves it. And it proved it on Tuesday. So if you were, like I said, we had the setup for short-term gains, and we got them. It's just a matter of whether or not you want to position your account to take advantage of those things. It was in the chart, and it's never 100%, The question is whether or not you want to position your account to take the gains that you don't know for sure are going to happen, right? Because it could have broken the other way. So anyway, Tuesday confirmed it, which was good. Okay. So last one really about Elliott Waves. How do they help? This is the 10-year Treasury yield. Okay. It's essentially the inverse of the TLT we were looking at, right? Because when yield goes up, prices go down. So that's why the TLT was down 50% while yields are going up. And we flip back and forth between yield and price charts, but same kind of thing. Bottom in yield in 2020, you get a 1, 2, 3, 4, and you're just waiting until you're confirmed that the 5 is complete. And so one of the ways you confirm that is you got a gap down here through that 20-day moving average line, consolidates back to it, and then drops again. That setup is saying we are getting some kind of move down in yield. Theoretically, it goes to the bottom of the prior 4. So according to the textbook, it would be something like that, somewhere around 3.3, which is not inconsistent with what everybody thinks is going to happen, Goldman Sachs and everybody else. That is what it would look like. So it's going to be interesting to see how this whole thing plays out, you know. And the question is, do you want to bet? Basically, right now the F fund looks great because you got a gap down. This is going to be a 1, 2, and we're in this three leg down for the F fund in yield, which means the price is going higher. Okay, so hopefully you guys get an idea of the value of Elliott Wave from that. Yeah, the other thing, really, if you're looking at a chart like this and you're going, okay, how does Elliott Waves help me? You can see this 1, 2, 3, 4. This is a good time to get in if you're buying yield, right? If you get a big 1 up and 2 down, this is the best place to get in because 3 is usually the longest leg. So the wave count helps you know where you are in the cycle. Okay. All right. So C Fund. We are actually putting together a couple of different models. We're going to be doing a good handful of different things next year, but one of them is going to be a model of what, we talk about it all the time, the weekly charts. So if you're just looking at weekly charts, this is the stack and this is a model. It doesn't mean you have to follow it. It's just a model. So what I used was, obviously these are weekly prices. This is the 20-week moving average line in blue. The relative strength indicator, CCI indicator, and MACD. Okay? So you can set this up on your computer. When price gets below the 20-week moving average line, RSI gets below 50, CCI gets below 0, which is the center line, and MACD turns negative. You get a red bar there. When all those things are in place, that's a sell trigger. And the reverse is a buy trigger. You get above the 20-week moving average line, RSI is above 50 and rising, CCI is above 0 and rising, MACD turns positive. That's a buy trigger. So if you were looking at this from back at COVID, that was a sell trigger. Okay? That would have been extremely painful. And this is the dilemma of sticking with the model.
Right.
Okay? If you have to pick a methodology and stick with it. Okay? If you're looking at the weekly charts, you know that COVID is in the news, right? If back in here, that's all anybody was talking about, right? Was this thing from China and all that. The market finally does the first move down on a weekly basis, and on a percentage basis, that's a big move. If you were from here to here, you're looking at that in your account, and you're going, this is not good. Yeah. I don't want to get out here because I know the market's just going to turn back around and go back up.
You know till you don't.
Yeah. Yeah, because back
But if you had this model, it would have given you a sell trigger, which
Yes.
would have said there's a big enough reason to get out besides the fact that it just went down. Right. That's the bigger picture, right? That's what these models are useful for is, the other way is you're watching the news and everybody's telling you the stock market just went down X amount of points or X percentage, right? And if that's the reason you get out, that's not enough.
There's no context there.
Yeah, there's no context. And so that's what's so great about building models like this and actually following the model is at least you're making your decision off more than one piece of data. Right. And not just more than one, but some indicators that are much stronger than just price.
Right.
That's the real takeaway too, right?
The momentum. I mean,
you're talking RSI,
and CCI and MACD
all together. That's overwhelming, probability in the favor of whatever it told you to do, buy or sell, right? And so that's what makes a model like this, and not just this one, right? This is just one. Again, Jerry's showing you guys like how you can do this and set your parameters up. Now, as he pointed out, though, the thing is when it starts to hurt a little bit, you can't just run for the hills because there's pros and cons to every model. Every model is not going to work perfectly in every market. It's
absolutely
impossible. It's
That's
impossible. But what you can't do is change models like weekly, go back and forth and go around. That's why we tend to kind of take time frames in and out to make decisions, but that's also a lot more work, right? It's a lot more time invested. And the way Jerry's showing here is a lot less time invested, but you got to be able to absorb some things, right? So I'm going to let you keep going there because that's a good direction we were going. So what kind of loss would that little downtick be? I can't really see the screen.
I should have
done the math.
It was 3,400 at the top and 3,000, so 10%, let's say.
Yeah, so you would have taken a 10% loss. What was
in 1 week?
Yeah, what was the overall loss though for that COVID drawdown?
Like 35%.
Right. So you didn't take the other 25%.
Yes, well,
theoretically,
but that's the next part of this. So the COVID obviously was kind of an aberration because it was 1, 2, 3, 4 weeks.
Yeah, it was a quick down and up. Right?
Quick down and up, right? So, okay, it wasn't a long-term bear market. You don't know that.
Yeah, it still took a while to get back up to the previous high, though.
It took some time, but you take that 10% hit in your account. And you're like, the market's down 10%. I can't sell it here. And I get that, right? I absolutely get that.
But you can sell it there.
Let's say you sell it there. Okay. The next time you have a buy trigger is right there. So you're basically flat, right? So you avoided this loss. You didn't get any of these gains. Okay. So you're basically flat. You should look at that and go, that's awesome. I avoided the COVID drawdown. It could have been much worse.
Oh, absolutely. This is not a bad scenario. This is actually a very good scenario if, you want to sleep well at night. You don't want to watch the market every day, 5 times a day. You don't want, you've got a job. You've got other things to do. You've got a family. But you still want to manage your retirement account and not just leave it to the wind. That's an unbelievable outcome. A lot of investors would be happy to have not taken that turmoil, right? And, okay, I didn't,
Yep. So if you got back in here and you stuck with the model, there were some times where it got a little dicey, right? That one was really close. But it didn't, it was, CCI was still above 0. And
you wouldn't have gotten a sell signal.
No, you didn't get the sell signal. It was very close, right? And this week, you have 3 down weeks in a row. So that's kind of painful. You're watching your account go down. It's kind of painful.
But you got to stick with the model.
You stick with the model.
Stick with your plan.
Stick with the plan, and it didn't give you a sell trigger. And you had a couple more times, but overall, we had this huge rally at the end of 2020 into 2021. Okay, so you got these gains to this week. That was another big move down. And again, you're like, I lost, say it was another 10% or whatever. It was that first down week in January 2022. A huge move down. And you're saying, well, why didn't I get out, why didn't I get out at the top? You have no reason to get out. If you had had that mentality, you would have gotten out on that week. Certainly in there somewhere, in here. The weekly model is what it is, and it gets it. You don't get these big recovery rallies, but you avoid big downturns. Okay, so we don't have to go one by one, but just by looking at this, we've had the last 3 years has been really challenging, right? If you were using this model, you were basically flat from COVID. You had this gain, whatever that is, in 2020 into 2021. You were out for this move down, the first part of the bear market in 22. Okay, you got back in right here. So you got in at a lower. It was right here. You got in at a lower place and you got out. We had this whipsaw. This was probably the worst part for this particular model, right? Because you got in here and you got out there, right? So now the model doesn't work, right? Because it put me in and the market rolled over and I got out. And then I get this big recovery here and I'm not getting any of these gains. I had to wait until it was here.
But you can't control the market.
Right.
So there's no sense in trying to. Right.
So
and we're always going to point out, you see where Jerry's drawing right there in that area. If you pull back far enough, that almost looks like a straight line across, right? It's all kind of flat. Yeah, there's some zigzags going on, but if you look at that historically as we go a little farther out, right, that's not going to be that volatile. And that is always going to be the most difficult time for anybody to make to manage your retirement account with the rules we have.
Yeah.
That's it, period. So do the best you can, but if the market is going sideways for months on end and you've got 2 moves a month and you got to make them in by noon, you just got to do the best. And so what I mean by that is a model like this, as painful as it may seem at certain points, should help you sleep better at night.
Yeah.
Because what you're seeing here is a way to make decisions not based on emotion.
Right.
That's right. That is to say that gives you a lot less heartburn and angst and anxiety is like an understatement.
Yeah, yeah.
You know, if you can truly find a model that speaks to you, whether it's ours or someone else's or one that you come up with, you're going to sleep better at night. You're going to be able to focus on other things. That's the most important thing, I think, is to be able to find a way to manage your retirement account, whether it's a 401k, your TSP, your IRA, your whatever. Find something that works for you. And you say, well, Conan, why don't I just go out and get somebody to do it for me? Well, good luck.
Yeah,
I mean,
you can do that.
You can. I mean, we don't know very many registered investment advisors that will help you manage your TSP. They say they will, but most of them don't. They don't do that. That's not what they do for a living. First of all, they're not portfolio managers. Right. But not to get sidetracked. But the point is, you know, from this model that Jerry's showing, it's a great way. It's one way, one of many, that you could actively manage your retirement account with. How many moves is that in the course of 3 years? 7 moves in 3 years, and you would have done pretty well. Yeah,
I mean, you're definitely not getting out at the top, and you're not getting in at the bottom, but you're catching the majority. You're avoiding the majority of the downside, and you're getting the majority of the upside.
And your account's going to be pretty happy for it.
Yeah, and you're. This comes down to how you look at things. Like,
it's all about perspective.
Oh, it is. It absolutely is. If your perspective is that you lost money relative to the prior top, you are in for a painful journey no matter what the market does. It's all perspective. And this last one is, you know, this was a sell trigger. And so you would have been happy as the market was going down that you were out of it. But you would have been very unhappy over the past 3 weeks because we didn't have a buy trigger to get back in yet. I imagine by the end of this week, the only reason we didn't have a buy trigger last week was because MACD had not turned positive. And that goes to, you know, momentum is not, there's still some question of whether or not this rally is going to hold. It's
going to hold. And you know, again, the takeaway here is that instead of just focusing on price as the be-all and end-all, it's just a starting point. Yeah. Right? It's where you start. And so, yeah, the price might be higher right now or going higher, right? So we're looking like we're at a rally, but the other indicators are telling us a different story. Yes, it could be, but we're not there yet. And so that's the part you have to feel okay about and say to yourself, okay, well, everybody else is saying, oh, it's up X percent in the last three weeks. Yeah, but these things didn't happen, so I don't care. Right? I mean, that's how we look at it, and that's how I would argue that most educated investors would say the same thing, right? Whatever their indicators are, whether they're fundamental indicators, whether they're technical ones, doesn't matter. They've made a plan, they've built a strategy around it, they're executing the strategy, and they're not worried about the blips on the radar screen, right? They're not worried about, you do pay attention to price, obviously.
Sure.
But that's just where you start.
Yeah.
You got to have some other things to back it up, to give it context, and to tell you what the momentum is, what the strength of the overall market is. Is it on an uptrend? Is it on a downtrend? Right. And just because it goes up for 3 weeks in a row, that sounds like a long time. And yeah, it sucks if you don't get to take advantage of it, but you're not day trading.
Yeah. Yeah.
So
the thing that it kind of cracks me up. Let's say here, this is the top. Let's say you're in the C fund, right there, and you stay in the C fund. Nobody's talking about this loss, because nobody wants to talk about that.
Yeah.
Okay.
Yeah.
They want to talk about these huge gains that they made in the past 3 weeks.
Yeah.
Right. And you did.
You did, absolutely. But nobody's talking about that down.
You aren't back to where you were before.
Right. We're not even there yet. Yeah. It's hard. We're never going to stop talking about it because we're always getting new watchers and listeners to this podcast. We're also getting new members that are coming from the sort of let it ride, buy and hold, however you want to describe it. If right now, if you're a buy and hold person, you feel pretty good about yourself. And that's okay.
Sure. Yeah, that's great.
But you have to accept that you also would have been buy and hold through most of that other stuff we just talked about. I got the chart back on the screen. And if you're going to accept that,
even just the most recent one,
you're not back to where
you're not back, to where the high was right here.
Yeah. So. And even go back to the other high.
Oh, you're certainly not back to this high.
Right. That's my larger point is you just rode that smiley face and you're not even there yet. You're not back. Yeah. And if you're going to, wave the flag for 3 weeks, you gotta be honest enough with yourself and other people and say, but looking backwards, I'm still, I would not be happy with this result if I was buy and hold since then. Because I'm not even, my account balance is not back up to where it was then. Right. And so, yes, did it raise a lot in the last 3 weeks? Absolutely. Yep. But you can't, this goes back to you can't pick and choose your models like every week or every month. I argue maybe you could do it every year, but really all you're doing is testing it then. Yep. You're not really doing it. You want to execute a model over 3 to 5 years. Yeah. Right? And that's painful to do. And that's why you'd want to pick a model that probably someone else built because they have tested it. Yep. But if you feel comfortable doing it, great. But the takeaway here is finding a model that works for you, that you think you can manage and you can do, and you don't really need someone to tell you when to do it. Now, it might help to know when others who use a similar model are making changes. That's kind of what we do, right? So we have a model that we use we use it as a way for our folks to validate, because sometimes you need somebody to go, okay, well, I don't know, this feels like when I should make a decision, but is it, right? And so it's just a nice validation point. We're not even though a lot of people don't really want to believe this, we're not telling you to move your money. Nope. We're trying to teach you how to do it. Yep. And give you a way to validate your decision so you feel more comfortable with it. Again, our model is not going to work in every market the best. Right. You just have to accept that. But we're not going to go changing our model because of it, because it performs well in the places we consider most important, which is we're not going to take those huge drawdowns. Right. And over time, we're going to be on the uptrend with the market, and that's what we want. That's what our model is built for. If you don't want those same results, then you're going to have a slightly different model or a very different model, right?
When Jamie Dimon said the worst likely result is stagflation, most TSP investors think that understandably so, because since 2009, the market has done nothing pretty much but go straight up, with some obvious blips in there. But the probability, let's say, the probability of the trend just we make new highs and we just keep going. The probability of that, I would argue, is low.
And not just you're arguing. There's a lot of people arguing it.
Yeah.
Right. I mean, most of the people, and we follow both sides of this, right? We don't pick one side because it agrees with us, right?
Yeah.
I mean, you tend to, and I know I tend to listen to the counter arguments all the time. And even though the timing of it may be different, like we talked about a few slides ago, with most people are agreeing in the general direction it's going, but they just have the timing different.
Yeah.
And so that's when we're talking about this potential, long-term trend down. It's not that people are saying that's not going to happen. Most people on both sides of the camps are saying, yeah, they just got the timing off a little, right? Yeah. So that should tell you something, which, we're headed to this is if you want to plant your buy and hold flag, I'm not sure now's the time to do it.
Yeah.
I
mean, if I was going to plant a buy and hold flag, it would be in the F fund right now.
Right.
100%.
Right.
I mean,
yeah. If you wanted to just be that simple about it, there's a higher probability that that's going to happen than the overall stock market is going to go back on a long-term trend up.
Yeah. Anyway, lots going on, and so the newsletters are really good. I hope people that are subscribers are actually reading them because the alert analysis is good. It's what's happening at the time we make decisions, but the newsletters are super valuable to read. And so if you want to sign up for it, you can do that at growmytsp.com.
Questions. As always, if you have questions, send them to us at support at growmytsp.com. Better yet, put them in the comment section wherever you find the video, and it's a lot easier for us to kind of answer you right there. So if you find this video on YouTube or you find it on social media, ask a question there. Usually if we don't see it, our support team's out there looking for them, and they let us know, and we do our best to get back to you. And again, if we don't get back to you for some reason in the comment section, we miss it or something, support at growmytsp.com, and it gets to us. All right. Hope you guys have a great week. And
Thanksgiving next week.
Oh, it is. Yeah. We'll be recording the day after Thanksgiving. We'll be all full, fat, and happy. All right, guys. Have a good rest of your weekend.